Hi, good evening, everyone. Today we have Mr. Nilesh Shah. We'll wait for a couple more minutes for people to join in, and then we'll start the session. So just bear with us for about a couple more minutes, and we'll go live. Thank you. Meanwhile, if you have any questions, please do ask us, and we should go live in the next 60 seconds or so. Okay. Well, thank you. Good evening, everyone, for being a part of this Icons of Investment show and Ask Me Anything show with Anand Kerati and Meera Money team. And today I'm very excited because I have none other than Mr. Nilesh Shah with me. Thank you, Nilesh Bhai, for taking all the time and rushing in for this. And I really appreciate you taking all the effort to be in the office today. Thank you so much, Nilesh Bhai.
It's my pleasure, Anand.
Thank you. So I know not many people need your introduction, but it's my duty to tell about you to people. Nilesh is the managing director of Kotak Mutual Fund, one of the largest mutual fund houses in India. He's also led his team to win a lot of awards when it comes to fund management. He's with Kotak. He was with ICICI earlier. He was with Franklin, and everywhere and wherever he went, he led his team to a lot of success. He is a part-time member of the Economic Advisory Council to the Prime Minister and also a part of UIADA. Thank you, Nilesh Bhai. So there will be a lot of questions that will be asked by people today, and especially around investing in current times, right? So these are times where, I look at it as a different kind of a period. We have elections coming up. We have small caps which have rallied significantly in the last 1 year or so, while earnings growth has been seen in large caps. The returns have not been as great as a small cap or a large cap. So I'm sure a lot of people are going to ask you questions about interest rates. They're going to ask you questions about gold, cryptocurrencies, and whatnot. So the floor is open now, and a lot of questions are expected to come in. While my own team had few set of questions. While the questions come in, I'll ask you one question, which is, and let's start with a bit of a controversial question, saying, what is your view on cryptocurrency? Should it be a part of anybody's portfolio at this point in time?
So, Anand, cryptocurrency is oxymoron word. Crypto is an asset, it is not a currency. And there is no scientific way to evaluate a crypto asset because there is no cash flow, because there is no dividend. Essentially, when you are investing in crypto, you are taking a call that there will be someone else who will buy from you at a higher price. As long as you believe in that call, you can go and invest in crypto. But please remember that there should be a bigger fool than you who will buy crypto from you. If you are the biggest fool, then you should
Yes.
not invest.
Got it. Got it. So because there's no cash flows and dividends, you're saying there's no way to value crypto. But there is another school of thought that says crypto is the new gold, or crypto has got a lot more regulated and there is a lot more structure to it. Do you think, and also there are a few ETFs that are being launched in US, right? So do you think that makes crypto a little more legal asset than what it was a few years back?
So, launching ETF does not give any recognition whatsoever. Number two, the creator of crypto asset like Bitcoin, no one knows who he is.
Ah, right.
In fact, there is a person who claimed that he was the creator of crypto
Correct.
and ended up losing crypto and hence wanted to recover it from the other holders.
Mm.
Do people know that 30% of bitcoins are today not traceable
Okay.
because people lost keys, hard disk broke down? Do people know that exchanges on which crypto was traded have gone bankrupt, have disappeared with clients' money? So, to me, it's a high risk, high return gamble. In many of our community, in the month of Shravan or on Diwali night, they play some sort of jua.
Right.
Teen patti bolo, jo bolo wo.
Uh, uh,
Crypto is nothing but another sort of teen patti. If you want to play for fun, play in a small quantum.
right. Okay. I think that's a great analogy, and I have a lot of questions already coming in, so I'll not ask you further question on this. So Malaysia asks you saying, what's your view on investing in an election year, pre and post?
So normally the world has seen that in election year, markets have done well, not only in India, but also around many other countries, including US and other emerging markets.
Right.
Why does that happen? Well, ahead of election, government and political parties loosen up their policies.
Mm.
Government will request RBI or central banks to to go easy on monetary policy. They will start speeding up capex to showcase that we have done this work. They will probably announce some schemes which will put money in the pockets of citizens, consumers, and all those money power either lose fiscal, lose monetary, or sheer spending will result into better activity, and maybe that's reflected into higher markets.
Right.
Now, this is generalization. We do see that on election day, when results are not as per expectation of market, there is swing. In May 2004, market was expecting NDA to come back. Didn't happen. Market shut down by going down 20%. In May 2009, market was not expecting UPA 1 to come back with higher number of seats. They came with higher number of seats, markets went up 20%. So election result day, markets can swing if results are against their expectation. But on the entire election year, if we go by past historical trend, thanks to loosen fiscal and monetary policy, generally markets do well.
Markets do well. Okay. Okay. So markets, I mean, that's a trend that you've seen in election year. So Ritaban asks a question saying, considering the current valuation in equity and other macro factors, please advise whether there is a requirement to rebalance portfolio, especially for aggressive investors, which I think he may have maybe some bit of small caps and mid caps in his portfolio. So do you
So,
suggest him to rebalance?
uh, well, it will all depend upon individual. When you say aggressive investor, that means in March 20 correction, you were a overweight equity in your portfolio and you were net buyer during March April 2020 period. If you were not overweight equity allocation in your portfolio and you didn't add meaningfully in March April 20 correction, then you can't call yourself an aggressive buyer. Assuming that you are an aggressive buyer, this is time to become neutral weight to equity. Now, as an aggressive buyer, it's likely that you will have higher allocation to equity, but bring it down to neutral level from overweight level. Second, within your portfolio, as you go from overweight to neutral weight, take some profit out of small cap, out of PSUs, and put that into large cap. This kind of rebalancing is needed to ensure that your equity allocation is in line with the valuation of the market. In a cheap market like March, April 20, you should be overweight equity. In a fair value market like today, you should be equal weight equity. And in an expensive market like Jan 2008 or maybe Jan 2018 in small and mid cap, you should be underweight equity.
So when you mean underweight, as low as zero.
No, 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 no. See, no one can time the market. So, assuming that you are aggressive and hence you want 70% of your portfolio in equity, then overweight means 85, 90, 95%. Equal weight means 65, 70, 75%. And underweight will mean 45, 50, 55%. I
Okay.
don't think so we can go to zero,
Zero.
but by going from 90-95 on the higher side to 45-50 on the lower side, you create a decent range.
Decent. Okay. Okay. So there's one question from Siddharth, which it's about government's provisional capex outflow at about 11% growth. So which sectors do you see gaining from this capex primarily? That's his question.
So, Siddharth, government's capex growth will be about 17%. Your number of 11% is budget FY25, vote on account FY25 over budget FY24. But if you look at revised estimate, the government is not spending as much capex as it was budgeted, and hence on the revised estimate of FY24, vote on account FY25 shows 17% growth. This capex is typically towards road, towards water, and towards railway. These are the three priority areas where government is spending money out of that 11,11,000 crore.
Hmm.
Obviously, there is money on defense equipments which is coming out of defense budget. Net road, railway, water, and defense. These are the four sectors where capex will be spent. One can play road, railway sector via cement kind of sector which goes in making cement or making sleepers for the railway.
Hmm.
It can be played via commodity supplier like iron and steel whose products will be used in railway, or it can be played via special service providers like signaling equipment company, uh, engine makers, bogie makers, and so on and so forth. My recommendation will be that while your top-down approach on capex growth is fine, be very, very careful in which stocks you are investing and what valuation you are paying. Please remember, price is what you pay and value is what you get.
Okay.
If you overpay, the sector will do well, company will do well, but stock may not deliver you return as you have overpaid.
Got it. Okay. Okay. I hope that answers the question, Siddharth. Sarang has a question, and he's a big fan of yours. He is requesting your advice on investing in equity after retirement, which a lot of people, a lot of time it is told that it is retired person should have more fixed income, but with a 30-year horizon between retirement and possibly death, right? Do you think keeping so much in fixed income and ignoring equity is a good idea?
So, Sarang, as Anand clearly mentioned, many of us are likely to have post retirement life which will be higher than our working career. Most of us started working, let's say, at 20 or 25, and we go up to 58, 60. Nowadays, people retire at 50 also. So,
Yeah.
your working career is anywhere between 25 years to 40 years. Many of us are likely to live in post retirement like more than that. And hence, it is extremely important for us to maintain asset allocation. If you are a retired person who is financially independent, not dependent upon their next generation, then it is extremely critical that you keep something in equity, whether it's 10% or 50%, that's your individual call. But your portfolio must beat inflation so that you have got real return, so that every year you are becoming richer and not poorer.
Hmm.
Inflation is a silent killer. And many a times people go to safety post retirement and much later they realize that inflation has actually eroded their wealth. You would not have seen anyone become billionaire by keeping their money in fixed deposits. Bankers become billionaire when you put money in fixed deposits. You don't become billionaire. The inflation is like a termite, keeps on eating your wealth. And hence, it is extremely important to maintain right asset allocation. Many of us are lucky that our next generation might take care of us monetarily. Now, we would love our wealth to be passed on to them in terms of a growth assets and not necessarily a conservative fixed deposit asset. In that case, again, you'll have to maintain higher allocation to risk assets, including equity. So, my recommendation will be you have to sit with people like Anand who can tailor made what is your risk profile, what is your investment objective, and what kind of return you want to generate by taking appropriate risks so that you can outperform inflation.
Got it. Okay, that's a good answer. I mean, that analogy again was good. So, Gautam has asked two questions. One is, when do you see the private capex coming into play? And between PMS, small case, and mutual funds, which one is a preferred asset or which is an advisable asset as per you?
So if we see private capex, it's coming up for big groups like Tata's, Birla's, Ambani's, Adani's. They are all spending money. They are borrowing money. They are raising capital and they are putting to investment. There are sectors where private capex has not taken off. For example, in automobiles, because there is supply limitation in terms of raw materials and chips and so on and so forth, people are not putting up large capacity. In two-wheeler, the peak sales was 2.5 crore units. Now we are at about 1.9 crore units. Obviously, there is unutilized capacity and there is electric scooter threat coming. So obviously, people are not spending money. Overall, if we see private capex has all the catalyst for growth, private balance sheet is fairly less leverage. They are generating cash flow and banks have money to give. Equity markets are ready to give money. What is missing in this entire picture is the threat of technological disruption. A petrol car maker doesn't know where he should invest in petrol car making or electric vehicle making. If he wants to go to electric vehicle making, does he have technology or not? Similarly, we are seeing in many of the sectors, businesses, technological disruption is coming, and hence people are withdrawing or deferring their investment plan till such time they can figure out what kind of disruption is going to come and how it is going to impact their business. My feeling is that we are going to see a slow revival of private capex, starting first at the top of the business houses like Tata, Birla's, Ambani's, Adani's. They are spending money. Then it will move to the middle of the corporate houses, and then finally it will come to small and medium enterprises. A lot depends upon how we are able to master technological disruption.
Got it. Okay. And among on the three choices, that PMS, small case,
Yes.
or mutual funds?
So on a same to same portfolio, mutual fund will always do better than PMS because they don't have to pay tax when they are buying and selling stocks. Second, most PMS will not get anchor allotment in IPO, whereas you will get anchor allotment in mutual fund. And in a Tejika market like today, anchor allotment does give some extra profit. Third, the usage of derivatives is far better in mutual fund than PMS. So for the same portfolio, mutual fund will deliver better return than PMS. How does PMS justify their existence? Well, they go and invest into either concentrated strategy. Most mutual funds will have 7,500 stocks. They will start with maybe 15, 20, 30 stocks. So concentration gives them higher risk but higher return. They also go into illiquid domain. They can be in micro caps, mini caps, small caps because their sizes are small and liquidity need is lower. Mutual funds by and large will play in larger cap and larger mid cap and larger small cap names. So by taking higher risk either through concentration in stocks, sectors, or by going into micro caps, mini caps, PMS will try to generate better return than mutual fund. So you evaluate mutual fund versus PMS on their investment process. PMS by and large will have higher risk and higher return.
Yeah.
Mutual funds by and large will have lower risk and lower return.
Okay, I got that point. So one question that came related to the private capex is, do you see this as one of the reasons for, or maybe one of the reasons for banks to start doing well, where the credit outflow by the corporates are lower than the personal outflows? Will this trigger a credit outflow rally for banks?
So banks are witnessing double-digit credit growth, and today their worry is deposits, not the credit.
Okay,
Yes, undoubtedly, as Anand, as you mentioned, incremental credit is more going towards retail rather than towards the corporate.
corporate.
Housing loans, auto loans, business, unsecured business loans, personal loans have now almost crossed $850 billion collectively for the household. Corresponding growth in bank corporate lending is not as strong. But this is a cycle. When banks were not getting enough corporate borrowing proposal, they went towards the retail side. Now they may swing to corporate side if they see great opportunity over there. Retail business is far more decentralized. It's in small tickets. Corporate business is far more centralized and in big tickets. And bankers will swing between one and the other depending upon what the opportunity is and what the risk return trade off is.
Got it. Okay. Okay. So there are. I mean, I'll also pause at 8. I have a rapid fire question that I want to ask you, because something that we have prepared for you. Now, there is a question from Ajay, and his question is: we have all seen PSU stocks and banks rallying in the last 12 months, while the fundamentals more or less have remained the same except for the last 2 years. What's your take on the future rally of such themes?
So some of the rally in PSU stock is driven by low floating stock. For example, Central Bank of India has 7% floating stock. 4%, 93% is owned by government. Now, when floating stock is limited, sometimes price discovery can be impacted. Uh, there are many PSU banks whose balance sheets have become absolutely squeaky clean. They have a great deposit taking franchise. And in today's environment, deposit is the constraints on credit growth. So you have to take stock specific call. Please don't get lured by past 6 months, 12 months return in a stock where floating stock is limited. That price movement might be function of low floating stock rather than improvement in business fundamentals. But should we be looking at investing in PSU banks? Answer is undoubtedly yes. They have a great deposit taking franchise. Lending standards are reasonably strict now across the banking system, including PSU banks. And balance sheets have become squeaky clean with very limited NPS, and they all have been provided for. and they are still available at a reasonable price. So one can invest into PSU banks, but just ensure that the market discovery of price is real.
Two questions around fundamentals, and then I'll jump into rapid fire. One is, what's your view on steel as a sector? And someone had asked a question saying, if will the railway capex continue the way, even if there's a new change in government? Do you foresee that? So steel and railway.
So steel is a commodity, and it's always difficult to predict commodity prices. What will China do, which is more than half of world steel capacity? Will government of India levy anti-dumping duty or not? Will the state or iron ore providers raise royalty or raise prices or not? There are too many variables to take a call on steel industry. You typically try to buy steel companies where operating leverage is high or cyclicality is high. What do I mean by operating leverage? If you get a steel company which is operating at 40% capacity utilization, and you have a view that steel demand will be good, and this company eventually will operate at 100% capacity utilization, that's operating leverage. Cyclicality, well, if you divide steel prices over last 10 years, 15 years, or 30 years, and divide that in two parts. The higher part is when steel's cycle is in top half. The bottom half shows when steel cycle is on the decline. Now, typically, you try to buy steel company stocks when steel prices have declined and are bottoming out and trying to move up.
Hmm.
Will you be able to pick up absolute bottom? Answer is no. But generally, based on last 30 years, 10 years price movement, you know that now steel cycle is in the bottom half of price or top of the price. Try to add on a contra basis when steel is in the bottom of the cycle. If you can catch up when they are bottoming out and moving up, great. But generally, that won't happen. And then try to be a seller when steel prices are at the top of the cycle. Will you get out at the top? Answer is no. But
Hmm.
by investing at the bottom half and exiting in the top half, if you have a margin, you should make money on steel sector.
Okay. And railways, what's your
I think
view on
whichever government comes to power will continue to focus on railway. Momentum has been built for railway infrastructure investment. Stations are getting upgraded, trains are getting upgraded. People are getting used to Tejas and Vande Bharat and those kind of trains. People are getting used to faster train, cleaner stations. It's unlikely that government will not continue with those policies.
Okay. So now I'll ask a few rapid fire questions, and these are something that my team made for you, and then shift back to the AMA, right? So you can say with shortest possible one rapid fire, right? Which is that one asset class that you like the most and one that you don't?
Equity I've always liked. Ponzi schemes I've never liked.
Okay. Okay. So what brings you more relief? I don't know, Friday markets are closing, or okay, Monday markets are opening. What gives you more relief or joy?
A bear market generally brings relief because now there's too many opportunities to buy. A
Okay.
bull market generally gives grief. What will you do tomorrow?
Tomorrow. Okay. So, what gives you pleasure as an investment manager? You have been doing this for many, many years now. What's one pleasure that you get from managing lakhs and crores of money?
So when we go out and you meet someone unknown who just smiles at you or who just blesses you saying that beta तुम्हारे वहां इन्वेस्ट किया था बहुत अच्छा लगा,
Absolutely.
that dua, that blessings, that gives the immense pleasure.
Interesting. Absolutely. Yeah. And what makes you, you've already touched this, so I'll ignore this. And the question was, what makes you nervous about investments?
uh, So now experience has taught us many things, and generally we don't become nervous even when markets are high or markets are low.
Yeah.
By and large, we know what we are doing. But can markets surprise you? Answer is yes. So, like an experienced cricketer going to bet, uh,
Hmm.
do you become nervous? Answer is no. But Are you watchful? Answer is yes.
Yeah. Okay. Okay. So, and I mean, we are seeing a lot of new age advisors, oh, sorry, investors coming in, right? So, what's your one advice to those new age investors?
So, new age means young investors, I presume.
Yeah. 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 Yeah.
Please follow three golden principles: regular investment, little drops of water will make an ocean for you.
Mhm.
Second, long term investment, jaldi ka kaam, saitan ka. So, be a long term investor. You don't grow a mango without waiting for 12 years. And third, have a diversified portfolio. The asset allocation decides how much money you will make rather than stock selection or instrument selection. It's not whether you have 100 bagger in hand or not, but it's how much money you put in when you got 100 bagger in your hand that will determine your wealth. So be diversified, have a diversified portfolio, do asset allocation appropriately, be a long term investor, and be a regular investor.
Okay. One last question there. What's your view on derivatives trading?
So, trading generally for an ordinary person is injurious to their financial health. Like in cigarette, 9 out of 10 smokers will face consequences and 1 out of 10 may not. Trading is something similar. 99 out of 100 ordinary traders will suffer, and 1 out of 100 who is extraordinary trader will make money.
Okay, okay. So yeah, that's also what SEBI is also published, Nilesh bhai. So one of the questions from Pankaj is: do you see potential, or does, as a mutual fund house, do you see potential in SME segment?
So, Pankaj Bhai, for us, governance is critical. Many years ago in TMT bubble, when I had lost money for my investors, someone very nicely told me, Nilesh bhai, don't make those mistakes which I can make myself.
Okay.
When I give money to you, I want you to manage it professionally. So the SME segment per se today is like a wild west. What will be governance practices? Who knows? Whether those businesses will have sustenance? Who knows? Today, they have delivered fantastic return to investors, but at what valuation? SME stocks are trading at three times valuation of large caps. Some of SMEs will do well invariably, but at three times price to earning ratio for SMA portfolio, I don't think so. It will do very well going forward. So, as fund manager, we will play in our area of strength, which
Mhm.
is evaluating large cap companies, larger and mid cap companies, where uh, we can understand their governance practices, we can understand their business models. SME is not our cup of tea.
Got it. So a couple of questions are coming because of this year being election year, right? So what one would you invest in lump sum, or should we stagger because of elections? And even if there is a, how do you approach elections, with what amount of cash percentage if there is a fall? So what amount of cash percentage should one keep?
So if you are an investor like Kumbhkarna who will invest today and wake up after 14 years to check what return has come, you
Hmm.
can invest lump sum.
Right.
But my fear is that even Kumbhkarna would have gotten from his sleep if someone had shown his mutual fund account statement of March 2020 kind of volatility.
Right.
So my recommendation to investors, not from a market point of view, but their own psychology point of view, is to invest in step systematic transfer plan STP,
Right.
divide it in a couple of lots, and then try to invest at regular intervals over next 3, 6, 9 months.
Hmm.
uh, Many a times you feel, oh, I should have invested lump sum. Well, yes, hindsight is always beneficial,
Right.
but purely from a psychological point of view, so that you don't get disappointed with the correction, try to invest on a systematic transfer basis. On election, who knows what the results will be? But we do know that markets are priced in Modi Sarkar. There is no doubt about it. If the election results are as per the expectations of the market, then probably there will not be material movement. But if actual results are against the expectation of the market, I do see a scope for correction.
True. Okay. So do you suggest then to keep some cash if there is a correction?
My recommendation will be that you go with neutral allocation to equity. And in case there is correction for whatever reason,
Hmm.
then try to become overweight equity at cheaper valuations.
Got it. Okay. Okay. Question from Nisarg is, what's your view on renewable energy? Is this the new thing, and should one go very aggressive on renewable energy?
So within renewable energy, Nisarg, there is a wide range. There is wind, there is hydro, there is nuclear, there is solar, there is green hydrogen, and who knows, there could be something else. Long back, you would have seen a Spider-Man movie where
Hmm.
there was a character, Dr. Octopus, who's trying to create sun. Now we hear that in California laboratory, they have created a sun which gives more energy than what it is received. And this experiment has been conducted twice, so it's not a fluke. Now, if something like this comes out, you can very well imagine what will happen to all other renewable energy stocks. Uh, Today, in many renewable energy counters, there is a lot of hope trade rather than reality trade. People are seeing solar rooftop installation announcements in the vote on account and are presuming that it will get converted into reality much, much faster and much, much bigger than what probably vote on account is proposed.
Hmm.
So my recommendation is that when you're going into renewable energy space, go with eyes and ears open. Try to back real players, not the marketeers or the companies where you don't know what their business model is. We had seen many a times in the past that when something does well, people just change name of their company and start positioning themselves as in
Yeah.
that sector. We saw that in telecom media technology bubble. We saw that in infrastructure bubble. So renewable energy right now is the craze. Everyone thinks it's a golden opportunity, but you'll have to be very, very careful at current prices.
Got it. Okay. What's your view on investing outside of India through LRS or mutual fund itself? Should one have investments in the US or any other country for that matter?
See, we have two neighbors, China and Pakistan. It's quite likely that we will be in confrontation with them rather than cooperation. And hence, it does make sense to diversify our geographical risk. Second, yes, India is a growing economy, but there might be other markets which will outperform India for a short period of time,
Hmm.
or there will be markets which are cheaper than India. Either way, from a diversification point of view, politically, geographically, business wise, it makes sense to diversify your portfolio. If you have obligation, like you want to send your kids abroad for education, you might as well create a kitty which is in the country where you want to send your kids for education.
Right.
So there will be multiple reasons why it makes sense for you to create offshore investment through LRS or through mutual fund. You should explore.
And this is in spite of the fact that it is tax negative in the sense it has got, it will be taxed at your income tax.
Yes, because you are seeking diversification, and sometimes diversification is necessary. It's like when you buy insurance, you don't presume you will be dead, but you still buy insurance. Same way it is overseas investment as a diversification insurance.
Okay. Okay. So how will you invest today? There's a question. One is, will you continue to invest in mid and small cap in spite of the fact that they are overvalued? If you are an SIP investor and are going to keep it for long term, that's one question that has come in. And one of the questions is, do you also invest in cyclical sectors? I mean, are you investing in bankings or pharma or auto? Are you doing any of these sector or cyclical sector investing as well?
So Anand bhai, I get 100 rupees salary. 40 rupees is taken away by government by way of tax.
Right.
Of 160 rupees which come to me, I put 10 rupees in NPS, which is 50% equity, 50% debt. I would have loved to make it 100% equity, but that's the maximum allocation possible. 10% I put into my provident fund, which is 15% equity, 85% debt. Balance 20% I put into SEBI skin in the game circular, which makes me invest from overnight fund all the way up to offshore fund.
Yeah.
It includes small and mid cap, it includes large cap, it includes hybrid, it includes everything. बैलेंस 20 रुपया रहता है, वो मैं अपनी बीवी को दे देता हूँ. So I don't have any investment. My decisions are taken by the government and the regulator.
Absolutely. Yeah, I know yours are like, yeah, regulator has a lot of control on you, right? At this point in time, one other question that has come in is, what's your view on these non-market linked investments like P2P, peer-to-peer lending, a lot of these bonds, which are NBFC bonds and company bonds that are becoming popular these days. Should one invest into them?
See, a good cricketer is one which hits half volley and not Yorker. Now, it's not that every Yorker you will get out. Some Yorker you can hit for a six. But by taking that as a precedence, if you start hitting every Yorker, you are more likely to get out rather than score run. Same way, it is not true that every half volley you will hit a six. Sometimes you hit a half volley and you get caught at the boundary line. But by and large, if you hit half volleys, you will score more runs and less wickets. And on Yorker, you are going to lose more wickets than score run. Same way it is between regulated and non-regulated investments. For example, debt is like your half volley. Surety of return is high, but the chances of losing wicket is low. But that's not going to give the return which you want. My recommendation will be take risk in equity rather than in debt.
Right.
Why go for lower rated NBFCs or corporate fixed deposits just for 1-2% extra? You might as well take that risk in equity and earn 3-4% extra. Second, P2P lending. Well, no harm in experimenting in a limited quantum. See how P2P functions. Always believe that whatever looks too good to be true is unlikely to be true.
Yeah.
There was a P2P equivalent in National Spot Exchange. What happened over there? People lost money, people lost capital. So experiment on P2P, see how it works, but don't bet big on it.
Okay. So experimental money is what that you recommend. So one of the questions from Vishal is he has an SIP in mid and small cap fund, and mid and small. You're also of the view that small cap you can reduce the allocation or book some profits. But with the SIP mode, do you suggest he continues with the SIP or he stops now? And he's a long-term investor.
So if you're a long-term investor, then continue with your SIP. But let's say you have overexposure to small and mid cap as a percentage of your portfolio, then let SIP continue and take some profit out. So depending upon where you are vis-a-vis your ideal allocation to small and mid cap, if you want to put 50% of your portfolio in small cap and mid cap and you are at 30%, please continue your SIP. If you are at 60%, please continue your SIP and don't bother about extra 10%. But if you are at 80% versus 50, then please take 30% out.
Okay. So there's one question with in line with the question that was asked earlier about P2P and NBFC, right? So one question is the risk same on NBFC and equity? NBFC
No. In NBFC, like ILFS, like Diwan Housing Finance, risk is very, very high. On equity, the risk is far lower. In NBFC, when your credit call goes wrong, you lose capital. There were, various companies from Lloyd's Finance to CRB Finance to so many other names where people have lost money. In recent time, people lost money in ILFS and Diwan Housing and Yes Bank Tier 2 bonds and so on and so forth. So a fixed income, when credit goes bad, is far risky than equity.
Hmm. So you're saying, in fact, equity is less riskier than NBFC, and of course, not all the NBFCs, but those lowly rated NBFCs also.
Absolutely. I
Yes.
mean, Yes
So you're
Bank
right.
shareholders are still making money, but Yes Bank tier 2 bondholders are crying.
Absolutely, absolutely. So at this moment, I also want to tell you that we have very recently launched a retirement booklet. In my team has worked hard and it's made a very good retirement booklet, and that link is available in the comment section. People who want to just have a gist of how to plan for retirement. I thought this is a day I should launch a retirement booklet, because a lot of people would be joining in for your for to ask questions. So it is already there. The link is there, so people can just download, and it is open. Anyone can download it and can share if you want to. So that the link is already there in the comment section. So please go ahead and one question, I don't know if you can answer, but the question is, um, how is it that Quant Mutual Fund, or I mean, they are using algos, and do you, as a fund house, as also use some type of an algo, and how different are those algos from what Quant uses?
So
Quant Mutual Fund.
yeah. So I don't have what quant uses, but I can talk about myself. We
Right.
believe future of investment is quantitative. We are using data analytics and pattern recognition to arrive at what we think is appropriate guidance for the future. We have launched a quant fund, and it has delivered about 13-14% alpha over last 4-5 months. It's a quant driven strategy on quality as well as momentum. And so far, what we had practiced in our laboratory has worked well in real life. For us, quant quantitative investment, quantitative analytics is still a learning stage. We have been working on it for last 2.5 years, and there is more to go. And we are using whatever is available to become better fund manager. Now, there are days when other people outperform. There are days when we will outperform. It's a marathon, it's not a sprint. As long as we can sustain ourselves and run, that's more than sufficient. Some people will win the race, some people will complete the race. In marathon, anyone who completes is also a winner.
Winner. Yeah. Okay. Okay. So, related to the quant, someone had asked me this question earlier also. What's your view on passive funds, and also these smart beta funds, these thematic factor funds and all this stuff? Are they gaining prominence overall?
So they
Right.
are all very much part of investment universe. When active funds are not able to add value or outperform benchmark indices, people will go to passive.
Hmm.
Smart beta passive funds are also one sort of value addition. And obviously, people will invest in smart beta index fund passive funds only when they are outperforming benchmark indices. So,
Correct.
passive, active, and smart beta, they all have objective to deliver better return than passive or benchmark index. Now, passive funds will never be able to outperform benchmark index because they'll have cost, they'll have transaction cost, they'll have transaction charges. Active fund manager has a chance. If he does well, he'll outperform. If he doesn't, he will not outperform. As an investor, you have to choose that fund manager who is able to outperform benchmark index and give value.
Hmm.
Now, 5 years back, we didn't have to worry because every one of us was outperforming benchmark index.
Absolutely.
Today, many of us are not outperforming. But there is a reason why we are not outperforming benchmark index because we haven't taken risky call on certain low floating stock counters. Over a period of time, if our call plays out, we'll again start outperforming benchmark indices. So there is no real, straight-jacketed answer here. You'll have to evaluate funds portfolio, fund manager's investment process, and then take a call whether he or she will be able to outperform benchmark index or not. If they are able to outperform it over a period of time, then you should invest with them. If you believe these people will not be able to add value, then you should go to passive fund.
Passive funds. Got it. Okay. And one question from Sarang was, do you see a lot of money from these physical gold assets, essentially because they are little dead, and government inducing them to move to financial markets in the future? Do you see that as a trend, like what is seen across in other countries?
And it's difficult to say. And then in last 3 years, financial flow of household into mutual fund is about 4.5 lakh crore. Now, this mutual funds will give some return, maybe 2%, maybe 20%, but some return. Double of mutual funds flows has gone into currency, cash in circulation. 9 lakh crore has gone from households' financial flows into currency notes. You and I both know currency notes does not grow.
Right.
They diminish in value because of inflation.
Right.
So forget gold. My competition is first with the currency. I have to
Right.
convince investors कि भैया पैसा cash में मत रखो. It's depreciating. It's like holding ice on a hot summer afternoon. You better invest in mutual fund. I hope one day I'll be able to convince people that instead of putting 9 lakh crore in currency note, it makes sense for them to put 9 lakh crore in mutual fund. Once I conquer that castle, I'll go towards gold also.
Right. Got it. Okay. And one interesting question is coming, which is, do you see similarities of this current bull run with that of what you would have seen in 2003 to 8? Is this similar?
So 2003 to 2008 bull run was on basis of strong economic fundamentals to begin with. Post Vajpayee government losing elections, market corrected sharply. Before that, it had a rally on India Shining campaign.
Yeah.
But economic fundamentals were real. Our current account was in surplus, GDP growth was good, banking system was stable, valuations had become reasonable, growth was picking up. From 2004, 5, 6, there was a minor correction. Until 7, things were on fundamental. We were still trading at about 15, 20, 22 PE.
Right.
It was towards middle of 2007 when Fed unexpectedly cut rates and pumped liquidity, and markets took off in globally as well as India. Infrastructure sector also took off brilliantly over there, and that's where market went into bubble. I was working in IPRU then. From September '07 to May 2008, we didn't launch a single NFO.
Okay.
It would have been much more easier to raise money. One of our competitor had raised money in their close-ended infrastructure fund, few thousand crores. My salespeople were after us that they can also raise 10,000 crore if we launch a close-ended infrastructure fund. And I'm thankful to Nimesh Shah, the CEO, who took a call that if investment team is uncomfortable launching an infrastructure fund, then we will not launch. We will not raise money. It's okay. So I will say right now the phase of bull market is like 2003 to 2006, 2007 early part. It is still not 2007 end part where one could see the bubble. Is there a part of the market which is resembling 2007 end part? Yes. All those stocks, especially in defense, railway, PSUs, which have started correcting now, but where floating stock is limited, that area one needs to exercise caution.
Okay. Okay. So I'll take two questions, and then I think we will have time only for two questions. One from Rohan is, what is your view on healthcare, domestic healthcare, and is there any opportunity there? That's one of the questions, and I'll ask the second one later.
So we remain quite bullish on domestic healthcare industry. As per capita GDP starts increasing, people will spend more money from roti kapda makan to healthcare, education, travel, tourism, entertainment. Healthcare will receive a higher allocation from individuals as well as government's budget over a period of time. That's the top-down analysis to be bullish on healthcare. On the bottom-up basis, I think healthcare is like Indian technology industry in 2000. Like Y2K solutions, we created and opened up gateway for global business in India. Same thing will happen on medical tourism side.
Okay.
Doctors, nurses, medicines, and the cost of treatment is competitive to rest of the world. And like tech industry provided solution to a desperate world, our healthcare system will provide solution to aging society, aging world. So we remain fairly bullish on healthcare industry from a longer term point of view. It's like technology industry between 97, 98, and all the way till today.
Okay. With so much money coming in the form of SIPs and mutual funds, do you think there will be a bear market ever?
Undoubtedly, money can pull market for a while,
No.
but thereafter fundamentals will prevail. And market is like, Puna mein namas. It will keep on coming. It's the law of the nature. There will be teji, there will be mandi, there will be bullishness, there will be bearishness. Money alone cannot prevent a bear market.
Okay. Okay. So yeah, so you're saying fundamentals will take over at some point in time, and that can bring in. The thing. What's your view on interest rates? Is it a good time to invest in GSEC?
It is time to go and buy the longest maturity GSEC available. We believe interest rates will come down from current level by 50 to 75 basis point over next 12 to 18 months. And hence locking in the longest duration will give you coupon income as well as capital appreciation.
Okay. Okay. So you're quite bullish when you said 50 to 75 basis points, because
Yeah.
we have not seen any semblance of interest rate cuts even in the last Fed meeting. I mean, what gives you confidence for 50 to
It's not a
75?
3 month call, it is 12 to 18-month call. We believe inflation is coming down globally as well as in India. And this is despite the fact that just now released American CPI data is higher than expectation. But our view is that notwithstanding such things, the longer term trajectory of inflation is down. That will create room for Fed to cut rate. There will be avalanche of rate cuts in second half of CY24 from May, June till December, and that probably will allow RBI to cut rates, and hence market yields, which today have a big figure of 7%, will have a big figure of 6% next year.
Okay. So while we are also bullish, but आप थोड़े मतलब we are like quite a lot more bullish. As a team, we are bullish on interest rate coming down. But this is good to hear from Nilesh bhai from you. Now, last question, and a question which I'm sure is favorite. Why invest in India?
So, there was this company called Suzuki. They were operating in Japan, doing well.
Hmm.
One day, they saw an opportunity in India to form a joint venture with government, and they came here.
Right.
Fast forward to today, in India, they sell more automobiles than what Suzuki sells worldwide.
Correct.
Maruti Suzuki has become bigger than Suzuki worldwide. Maruti Suzuki stock, since its listing in 2003 to 23, 20 years, has delivered more return than Toyota, Honda, Suzuki, and Nissan put together in Japanese market. This is the reason why you should invest in India. We'll have many more Maruti Suzukis in India, which will become bigger than their global parent. and their stocks will deliver bigger and higher and better return than their parents and competitors return put together.
Okay. So you also strongly believe it is India's decade, right? I mean, that is something that
Undoubtedly, it
okay.
is the Indians who will have to work hard to make it achieve. So it's not something which we can take it for granted.
Hmm.
We are still a poor developing country. Our per capita GDP is still $2,500. There is still 70% of Indians who live sub-Saharan Africa life standard. So there is a hard road ahead. But if we walk on that road like we have walked in last 10 years, there's no doubt that we will be the best performing market globally.
Okay. So that's great to hear from you, Nilesh bhai, especially saying that we should be, if we do the right things, the best performing market. And it is always a pleasure talking to you. I really thank you for taking the time out, and I
Thank you.
sincerely hope to have you again and again in this show. Thank you so much.
Definitely.
See you.